Okay, let's get you started, guys. Thank you all for tuning in to today's show. I'm going to be speaking to NorthmanTrader, Sven from NorthmanTrader today, about all things Bitcoin, macro, and what the hell is going on out there in the world. But before we get started, I've got a quick announcement with my sponsor. Relay app is supporting me for this episode. Relay app is the easiest way to buy Bitcoin in Europe. Check it out, Relay app. Sven, welcome to the show. Good to have you. Sven coming up. I've just put him up. Let me see if he's going to accept to come up on stage, and then we'll get started. Are you there, Sven?
Glad to be with you, Archie. Looking forward to this.
Good to hear you. You're coming through nice and clear as well. Sven, I've been in this space for about 2 years now, just a little more than 2 years, a little bit less with this account, but I was kind of lurking on Bitcoin Twitter before I started this. And I recall you, and correct me if I'm wrong, but you were a bit of a skeptic when it came to Bitcoin. And not too long ago, you kind of changed your mind. Can you give us a little bit of a background on what your thinking was and how you came to change your mind on that?
Yeah, I'd be glad to. So first of all, yes, I was a bit of a skeptic as I looked at the global macro picture and just obviously have been long-term critic of all the excessive money printing that we've seen for years flushing through the system. So clearly concerned about asset bubbles in general. But I also am a technician, a market technician, looking at technicals as they evolve. And I noted over time that Bitcoin was trading technically very nicely. So my initial interest was there from a technical perspective. My wife has actually been a long-term bull, and she's chastised me over the years. She's had some amazing trading calls on it, but I was still structurally concerned in terms of what I saw to be kind of bubblicious behavior in a lot of underlying crypto events. But I tried to keep an open mind, so I had a few discussions with Michael Saylor since last year, and these discussions evolved. In fact, one of the key points of interest to me was, and coming out of the Michael Saylor discussions, as we were discussing last year, which I consider to be a large asset bubble with a lot of froth coming through. And that was, yes, we had something similar before that you guys all may recall. It's the infamous tech bubble crash. And at that time, if you look back in history, obviously we had massive valuations, we had exuberance, big retail participation, and so forth. And then we had the big blow up. And the big blow up actually offered a key differentiation, and that is the non-sustainable business models that were truly rooted in bubble behavior. They all disappeared. They all got killed, the pets.coms and so forth. So it was a big cleansing process. And even the eventual big winners that actually offered a long-term, very solid outlook, like Apple and Amazon, they got hit 85, 90% down. So brutal drawdowns. And of course, if you bought at the peak, tech bubble, you were crying on that drawdown. But obviously, if you look back in history, those proved to be absolutely not only winning business model, but having a global scale and proposition. And so that's where my view evolved from a fundamental perspective as I looked at Bitcoin, because while we are still in a period where we don't have the regulatory clarity that we all see, I'm also not blind to the fact that it is taking on institutional adoption, and it offers a global footprint opportunity long term. So I've approached at the beginning of this year when obviously Bitcoin was already under pressure, and with the view that we are in the process of right-sizing this market as central banks will have to remove liquidity and tighten monetary conditions, that while we see this drawdown process and the bubble cleansing itself in the sense that we're seeing asset valuations come down, then this offers for someone like me who didn't participate in the uprun and didn't chase that, but it offers, from my perspective, an opportunity like 2000 when we see maybe longer term structural bear market, which is still subject to discussion at this point. But if we are into this process, and so far that seems to be the case, then weakness on an asset such as Bitcoin, to me, is a patient and technically based accumulation opportunity, especially once we have the regulatory clarity. And once we're through this phase here where central banks are trying to desperately to get inflation down, and eyes are wide open that this is a process. So I'm being very patient here and very nimble as I'm looking at the various technical pivot points where I'm interested in adding. So that's kind of my evolution on Bitcoin.
So the analog with the tech.com bubble is very apt, in my opinion, and particularly the examples that you choose about the eventual winners, which had fundamentally sound business models that would go on to capture future value in some future economy as it became more and more digitized and online. So I'm interested in specifically what is the property or the benefit within Bitcoin that you saw that was worthwhile to accumulate now. So my understanding is you've started to accumulate, you haven't finished accumulating. Is that right?
Yeah, I'm in an early process here. I started a little bit in January and did a little bit this summer, and the pivot points always for me at technical points. And I've highlighted this chart before, and in terms of the uptrend on Bitcoin in the summer, there was a trend line around 17,000. I pointed that out in my discussion with Michael Saylor, and that was a bounce point. But it's not clear to me yet that we've reached a structural bottom in overall markets or in Bitcoin at this point. So I remain patient, and I'll just keep adding at that point. In terms of properties, well, I think the big issue or the big revelation in a sense is that we have an opportunity for a global system that can be used anywhere at any time with a limited supply. Part of my frustration here, and maybe this is why I also called the article at the time "Revolution," is because we have this monetary system imposed on us, and we have no say in it whatsoever. And in my view, central bankers over the last 14 years have been really careless and reckless in how they've implemented policies largely to the benefit of the very few at the expense of the many. The era of cheap money that was imposed by central bankers was advertised in a way for a long time to be consequence free. And the illusion of that consequence free aspect of it was given by the fact that we had no inflation, and they were able to intervene every single time, despite the consequences that we already saw before inflation hit hard. And that was ever increasing wealth inequality. There's 80% of stock assets owned by the top 10%. The push into obviously ever increasing housing prices that got exacerbated now during COVID, but it was again the Fed buying $1.5 trillion in mortgage-backed securities into a supply-constrained housing market that has now produced the lowest housing affordability we've basically seen in decades. So it's pressuring the middle class from cycle to cycle to cycle as people are increasingly feeling left behind. And it's not only the Fed, it's always been a global phenomenon. And I think in terms of us as being, citizens across the globe that have now feeling the impact of the consequences, namely that both the combination of monetary and fiscal excess have really squeeze the middle class even further here with negative wage growth and still no end in sight to inflation. We can talk about peak of inflation ultimately coming down, but as we saw on Friday, Jay Powell finally, and I say finally because they've been waffling on this for quite some time, sent the right message, which is pain is coming. Unfortunately, the pain will again be, or the majority of the pain will again be carried by the most vulnerable, that didn't participate in the asset inflation aspect of the last couple of years, but then got stuck with the high inflation and hurt disproportionately by the high inflation. Well, they're going to be the first in line to lose their jobs. So I keep questioning not only the sanity, but the veracity of the policy construct that central banks have so far, consequence-free for themselves, implemented, because no one's holding them to account, which is very unfortunate. Even on Friday, while I may welcome Jay Powell finally talking about what is required, there's been absolutely no acknowledgement as to some of the factors I just highlighted. There's been absolutely no acknowledgement of the mistakes and the consequences of which. So I think the institutional trust is extremely low. And I would just maybe finish on this point. The Fed and its speakers that we see basically filtrating through markets every day with speeches and comments, they do not make themselves available to any critical audience. It's always kind of a soft questionnaire type situation, and that's very unfortunate. It does not help. I think the Fed needs to have a period of accountability where they acknowledge what they do and what the impact of what that is. And then for years they've denied the direct correlation between QE, for example, and zero interest rates and the impact on asset prices. Flat out denied it. In fact, Jay Powell was now a couple of years ago. He actually stated that Fed policies absolutely do not impact wealth inequality. It's just a false statement. Absolutely it does. So I think Bitcoin has a real opportunity for the global citizenry to have ultimately some form of independence in a way, maybe to opt out to a degree. And from that perspective, I see it long term actually as a hedge, even though it doesn't act one like it right now, which I freely acknowledge, because it is still benefited from the liquidity bubble that really lifted all asset classes in the recent years. So I think that's why regulation is going to be so absolutely key, because a lot of the institutions that may want to really opt into Bitcoin still can't without that regulatory clarity.
You make some excellent points about the lack of central bank accountability, and I want to delve into that a little bit more just later on. But just while we're talking about your foray, your entry into Bitcoin and your decision-making process, perhaps if you can share some of that to help others understand how you mitigate the dual risk, because like you said, you're a market technician and you would have seen some of that weakness creeping into the Bitcoin price chart around about January when you made that declaration, and also knowing that inflation was on the rise and that QT or interest rates would be rising soon, if not at that particular point. How did you rationalize those two risk factors and still continued to begin your accumulation of Bitcoin?
Very simple, and that my operative word was nibble. I mean, I have a particular number in mind of how much I want to be exposed to it, and I'm not anywhere near it. Bitcoin going down right now I don't care, frankly. I actually welcome it because it gives me an opportunity to accumulate at lower prices. So I've absolutely no problem with what I'm seeing. In fact, I'm welcoming it in the sense that I see, per the 2000 example, that I see a lot of the crypto fluff out there being basically wiped out. I mean, that's what needs to happen. That's why I think structurally we've all forgotten that recessions used to be actually a good thing. While they're painful, they are supposed to be a cleansing system, a mechanism in the system, because you don't want to end up with an economy kind of the way we have it now, where you have a lot of inefficient business models dragging on growth in general. I mean, close to 25% of companies on the Russell 3000 are zombie companies. They have more debt than they can actually generate any kind of income, and that is ultimately keep in mind, structurally, we've been running into ever lower growth in the last 20 years. Part of it may be demographic related and technology related, but the fact is we've been choking at the economy because they intervened every single time. As you recall, after 2009, the global financial crisis, QE1 all made sense to me. The rescues made sense to me. I mean, the financial system was close to collapsing, so I understand they have to intervene, and I'm not complaining about central banks intervening. Like COVID, they had to intervene. I get it. It's the degree and the pervasiveness of it, because they continue to intervene in the in-between periods when it wasn't really necessary. The famous example is December 2018, when the Fed was on its path to raise rates and to reduce its balance sheet. And then the 10-year hit 3.5% in October of that year, and when markets immediately collapsed. And what did the Fed do? They flip-flopped in reaction to this. And they keep talking about the dual mandate about price stability and unemployment. Well, in 2019, core inflation was 2%, which was at the target, and unemployment was at 3.5%. And what did they do? They cut rates 3 times, and then they started expanding the balance sheet again. Why? What was really necessary to do that, right? So again, that was a situation where everything got saved, and the S&P flew up 30% with zero earnings growth in that year, and so you keep exacerbating asset bubbles by always refusing to let the system cleanse itself. Now, this time around, maybe things will be different, and I think that was maybe the message from Jay Powell.
Yes. I mean, recessions are the economic bushfires that clear the landscape and make room for regeneration. But we haven't had that in almost 2 generations. We haven't had a decent one for quite some time now. And as you said, we've got a lot of zombie companies and zombie industries that are just hanging around. And I dare say maybe even a zombie generation in the human landscape as well. One last technical question, and I know this has sort of become trite, but I'm interested in your opinion, because this is the first time we've had a chat about this. Since you have started acquiring Bitcoin, it still has been subject to the flows of investment managers, and it's still treated like a risk-off asset. Do you have a view whether that will change, and do you have a view as to what might catalyze that?
I may be wrong, but my view is it is regulation, and at this point we, keep in mind, this was one of the things I've been pointing out for a couple of years, this in general really high correlation between the S&P or NASDAQ, if you will, and Bitcoin itself. There have been periods when that correlation veered off quite significantly. For example, we had that in the middle of 2018, and then we had it again in around 2019, 20, and in 21. So there have been periods where it's veered off, but we had periods where we literally had a 90% correlation, and you can tie it to liquidity. Right. So in 2017, you had the tax cuts, right? And we had a big liquidity flush coming in from that. Then, of course, 2019, as I mentioned, rate cuts, QE, and then obviously in the last couple of years, the so-called unlimited QE. And since we started the tapering process in QT, it's kind of all gone down the same way as in during the rallies. I have to say this though, okay, and this is what I just noticed here in recent weeks, a couple of months. During the summer rally in equities, Bitcoin, while it rallied, it veered off on the correlation a little bit as well. So it's kind of been lagging. So my view is it's still all tied to overall liquidity as a result, knowing now that the Fed is supposedly serious about getting about restrictive monetary conditions. From that perspective, I have to say there's further downside risk in all asset classes, including Bitcoin at the moment. So I think the pain trade may not be over yet.
I just want to correct myself because I think I said Bitcoin trades like a risk off asset. I meant risk on. When risk is on, it goes up with tech stocks and the like, and when it's off, it goes down. So I just wanted to add that correction for people listening out there. I misspoke. Now I want to move on to what caught my attention recently and led to me reaching out to you for this discussion. Of course, I've been following you for some time, and I've seen your various posts and articles and threads, and particularly the charts as well, which I really do appreciate. Which is on the macro landscape. You said that Wall Street has effectively become a Fed gaming operation, and that the Fed is the biggest driver of market direction. And I guess, in my words, rather than supply and demand based on fundamentals, we're seeing essentially the tide of liquidity coming into and out of markets determining what's going on. What led to, I guess, can you give us a little bit of background as to where you think that all started and how we got to where we are right now?
It's funny. I posted a cartoon today from the 1980s. It was just a reflection of, a person sitting in front of the TV and hearing about how markets went up and down based on interest rate expectations. So I won't say this is new at all. I mean, it was eerily similar to kind of what we're seeing now. But the fact is, central banks, through their balance sheets, have become the biggest participants in markets. I mean, last year we got close to 31 or 32 trillion dollars in global balance sheets of central banks. It's just an insane amount of money.
Sven,
And
can I just interrupt you really, really quickly? When you talk
yeah,
about the Fed's balance sheet, I mean, is this a balance sheet of any consequence, or is it just a black hole where assets get sucked up?
well, you may recall the term TINA. There is no alternative, right? Along with interest rates, and you have also this gorilla in there buying all the bond assets. You're creating an imbalance. You're shifting the natural equation of supply and demand, and so you're basically forcing uh, buyers of assets into a yield generating environment where they cannot get it in the standard market anymore, right? So if you don't earn any interest on your bonds, you got to go into stocks, right? And it's kind of been a psychological factor that has evolved over time because people started wising up to the Fed, the mantra, don't fight the Fed. And that's why literally T for T, I once put out a chart, from 2009 to 2020. It was just every time there was any mention of QE or pausing or flipping or flopping, you just had a real big pile into assets because people were literally trained by the Fed that that's what happens. Whether it was fundamentally justified or not, it didn't matter because it worked. It mattered in that sense, because it becomes crowd behavior. That's why the summer was so interesting. I had put out this technical article about, we're just expecting basically a big bear market rally based on the technicals, right? And one of the justification would be a rollover in yields because higher yields. Keep in mind, we've financed everything in the last 15 years with cheap money. I mean, this massive debt expansion, right? That's why they got in trouble in 2018 because the 10-year rose to 3.5%, and the debt construct back then already set a signal. This is not working. You're going to get in trouble. That's why they flip-flopped. And then we've added $8 trillion in debt since then because, tax cuts and then COVID and everything else. It's been an absolute historic expansion. But it's gotten psychologically so pervasive that, I think investors just are all caution into the wind. So when the July press conference took place, right, Jay Powell, we had rallied a little bit, but we were, from mid-June into July, we had rallied a bit, worked off some oversold conditions, but there was still a bunch of volatility back and forth. But it was not until Jay Powell came out and gave this press conference where he mentioned that the Fed was at neutral, which baffled a lot of professionals in the economic field, because we're not anywhere near neutral. We're not even anywhere near restrictive at this point, historically speaking. But markets, who obviously had suffered a lot in the first half of the year, right? This was one of the worst first half of the years ever. They took that to be dovish, meaning, hey, the Fed they're considering themselves at neutral. Maybe they do a little bit more, and let's assume the next Fed pivot is coming. And we just went off to the races, right? We had these 25% move. Heck, Apple almost rallied, 35% or something like this. Absolutely massive move. And ironically, after that happened, it didn't matter what any other Fed speaker said, because they kept going out there and talking about hawkish, but no one's taking them seriously. Why? Because they've never been serious about anything. They always flip flop. That's what the psychology has been. And then so people piled right into the key technical reconnects, like the daily 200 MA on the S&P, the weekly 50 MA on the Russell, and that was just not the place to go long. It was maybe a short opportunity, or easing of exposure, because we did see the technical reaction. But I tell you what, the worst thing that happened here was, because of all that interpretation and all the assets rallying back up, financial conditions eased significantly, which is exactly not what the Fed wanted to see, because you cannot beat structural inflation with easing financial conditions. You just can't do that. I mean, that was the mistake in the 70s. And I think this is why Jay Powell came out on Friday with this rather terse, short 8-minute speech, and basically put the kibosh on it and said, yeah, pain is coming, which is the right thing to do, because you have, and this is the other challenge that I think everybody has to recognize, you have to have restrictive monetary policy. That was the example of the 70s and 80s. You got to have restrictive monetary policy to get inflation back down. The worry in all this is that, while they were able to do this aggressively in the 70s and 80s, back then debt to GDP was around 30%. Now it's at 125%. So the question is, and this is the other historical analogy that's of key here, is typically the Fed raises rates until it breaks something. Well, how much further can they go before they break something here? Because they're talking about restrictive, they're talking about 4% effective Fed funds rate. We're only at 2.33%, and the housing market's already rolling over big time. Right? We got 10.9 months of new home supplies. If you look at the last 50 years, every time we went past 9 months, we had a recession. So I think that the message that the Fed has not clearly spelled out yet, but that was spelled out by the Bank of England and the Bundesbank in Germany, is a recession is coming. It has to come, because that's the solution to get rid of inflation. But that also means that, if you just chased up all these assets back, with these valuations, maybe you were a tad too optimistic, because that means earnings have to come down, and they will come down into 2023.
So it's really interesting that you mentioned that cartoon that you posted, because I mean, in my lifetime, I remember early in my lifetime there were recessions. I don't remember the 70s, but there were recessions in the 70s. Certainly in the early to mid 80s, there was one in 1990, 91, and then we had the dot-com bubble that led to a recession. In between that, we had the Asian financial crisis. But something seems to have changed. I mean, that's what I can put my finger on, is that the 2008 crisis elicited a response unlike anything we've seen, and nothing has been the same since. Why do you think that is?
Well, I think, first of all, there's real fear. As I said earlier, I think we were actually maybe just hours away from the global financial system blowing up. I think that left a psychological mark, for sure. And ever since then, and after QE worked, in the sense, the first QE program, got housing back, got markets to rally again, and averted the big problems. It became a tool that was maybe easy to use, right? I mean, as soon as they stopped QE1, markets dropped again 20%. And that's when Bernanke back then, as Fed chair, came in with QE2 and then Operation Twist and QE3. And then other central banks started realizing, hey, this this works, right? So they started, maybe that was not their intent, but in effect, what they started to do is to start managing the economy via direction of asset prices. And actually, Bernanke said this in 2012. When stock markets go up, consumers feel more confident and they're going to spend more. Going back to the 2018 example, that quarter when all of a sudden asset prices dropped 20% into Q4 of 2018, retail sales immediately tanked. So here's the thing: by having created the TINA effect, we're seeing, historically speaking, an ever larger allocation of funds into stocks themselves, right? The old saying is the stock market's not the economy is not the stock market. Well, that's only true to a certain extent. If all of a sudden all your 401ks drop and your trading accounts drop, you're going to probably feel less enthused about spending a bunch of cash in the economy. That linkage is definitely there. And so maybe to some degree the Fed got a little scared there in June because things were dropping pretty hard, and that made it very clear that we're actually going to head into a recession. So in order to avoid that, maybe that summer rally, and maybe it wasn't a mistake when he said neutral. Maybe that was intentional. I can't say, but it certainly helped now to bring, as you saw today, consumer confidence magically back up. Why? Because we just had a big asset rally. So don't tell me these things are not linked and intertwined, right? So to just elaborate on your question, yeah, it became an easy tool, and it helped politicians because whenever there was trouble, just call for the Fed to the rescue, and magically everything is back in line. All trouble is averted. My structural concern simply is this: we keep doing this, and at the same time we are disconnecting the size of the asset classes ever farther away from the economy. This is an I'll just mention this example because it was, at some point nothing mattered anymore last year, right? I mean, the S&P was basically an index tracker to the Fed balance sheet. But we got to a point where the stock market was over twice the size of the actual underlying economy. Yes, we got companies acting globally, and so there's, you've got the big tech companies that have a global footprint and so forth. So yeah, you can maybe say maybe it should be a little higher than history. But what is history? History was, this was 60 to 85%. Then we had the tech bubble, got to 155%. As you know, the tech bubble crashed. It bottomed at 75%, basically the historical mean, if you will. Then we had the housing bubble. It went to 137, 140%. It bottomed at 50%. And then last year, December, we got to over 200%. Sorry, folks, at some point, you need to have a productive economy, a structural foundation that justifies a asset valuation being that far disconnected. And yeah, you can have the illusion with the government throwing out free money every which way, but is it sustainable? My contention is it's not. And the summer, ironically, when we bottomed in mid-June, we actually hit 155%. Market cap to GDP, which was the peak of the tech bubble. So if that's your new definition of a structural bottom, okay, then you really have to say it's truly different this time, right? And that's my concern. That's what I'm thinking. While we're still debating, was this a structural bottom in June, or are we still at the beginning of a structural bear market that may last a year or two? Because we haven't seen one of those in a very long time. And the only reason we haven't seen this in a long time is because of continued central bank intervention at any sign of trouble.
So we've seen both the White House and the Federal Reserve try to hold on to a narrative by their fingernails. The White House with that ridiculous zero inflation headline that they tried to conjure up that didn't really take off except for ridiculing the White House for even attempting it. And also the Federal Reserve, what did they say? That we're not in a recession. So denying the long, widely accepted definition of what a recession is. A technical recession is 2 consecutive quarters of GDP contraction. We've got that, and yet they're insistent that no, actually, we're not in a recession. There are other factors to consider. There may well be other factors to consider to inform your decision to act and policy, but everyone is pretty much in acknowledgement that the economy is in the toilet at the moment and things are only going to get worse. So together with this, everyone's also saying that the commentary in the marketplace is they will keep pushing until something has broken. Is that going to be possible for much longer, given where the economy is at now, the data that's probably about to come in the next few months as well? How long will the Fed be able to hold off talking tough like this?
Well, first of all, I mean, let's be aware that there's always political motivations. I mean, whether it's Democrats or Republicans, if you're going into a midterm election, you want to keep a brave face on things. You don't want to talk recession. That doesn't cheer voters or potential voters up. So I would view politics in general through a huge lens. Call it grain of sand, if it will, whatever they're saying. So with the Fed too, I have to say, it's kind of frustrating because you're not really going to see a Federal Reserve coming out advertising a recession. We've seen that time and time again as well. It was Bernanke in 2008, who saw no recession coming. I see no recession. Housing market, subprime is contained. That was the famous quote. And of course, before that and after that, it blew up in everybody's face. So we have to be all mindful that to a certain degree, these officials are also cheerleaders. If Chairman Powell came out on Friday and says instead of pain, which did produce a reaction in markets, but if he said, we're going to go into a recession, it's going to take a deep recession to get rid of inflation, the S&P would be at 4,000 now, right? There's the risk that it becomes a self-fulfilling prophecy, obviously, right? So we all have to be mindful that the public communications are intended to be jaw-boning, right? And they do that with some caution, but they will not warn you. I mean, the Fed has never warned you that something terrible is going to happen. So just be generally mindful of that. Here's the reality. Interesting enough, with the Fed rate hikes so far, we're just slightly on the effective Fed funds rate above where we were in 2018. They were 2.25 then, now they're 2.33. It's not restrictive policy. And several of the Fed presidents, including Powell, have now talked about being restrictive. That means rates have to go higher, which I agree with. They do. But
can I just interject there?
Sure.
I mean, restrictive has to be a subjective term, surely, given the broader economic context. And one of the things we haven't quite touched upon yet, but which is looming large in the economic equation, is the enormous debt that governments have, that consumers have, households, businesses as well. But mainly the government. The debt to GDP ratio at the moment is unprecedented. And so doesn't that have to be taken into consideration when we consider whether or not 2.5% is restrictive or neutral versus what historical norms might have been?
Well, yeah, I mean, look, restrictive actually means the effective Fed funds rate has to be over what the PC inflation rate is, which is 6% currently. So
but that's a heuristic rather than a rule, right? That's just a heuristic based on history.
Yeah, based on history, and I would agree with you that the large debt construct. And keep in mind, by the way, a lot of this U.S. debt, I think to the tune of $8 trillion, next year has to be refinanced now at higher rates. If you look at the chart on the Fred, the St. Louis website, you see the interest payments on debt already going to new all-time highs. That's without the July rate cut even having taken effect. And that's the other thing. None of us, folks, are used to a restrictive policy. And if you look at the recent, let's say, 40 years, what has been the trend? Because as debt has grown ever larger, the Fed's path to rate hikes has been one of lower highs and lower highs and lower highs. So any Fed rate hike from here is a fundamental historic shift, because vis-a-vis 2018, it now represents a higher high into the highest debt construct ever. And I submit to you that none of us know how dramatic of an impact that can have. Keep in mind, it's not only government debt; it's corporate debt. You name it. I think consumers in general obviously have massive debt as well in terms of their ratios. Income ratios is probably a bit better than it has been. But the reality is the cost of carry is increasing. So the Fed, whether it does 50 basis points or 75 basis points in September, that is going to have a lag effect into the economy into next year. And they're not going to be done at 50 or 75. They've now clearly stated, and they stake their entire credibility on this now. That was the point of the speech on Friday, is that they're going to at least 3.5% to 4%. So that is an undiscovered country, folks, because as I said, housing, you already see that impact. But housing in terms of actual prices is still sky high historically. So the cleansing process on that basis has yet to take place. Goldman Sachs, I think, came out today with a projection. What was market slowdown, something to the effect, in terms of housing into next year. Housing is a huge part of the economic sector. So, while no one's using the R word, that's what it is. We're looking at a sizable recession to come. So this, and I also noticed, by the way, Jay Powell has suddenly dropped his mention of a soft landing. That's what he was talking about. It went from soft landing to softish landing to now no mention of it whatsoever. Maybe people need to pay attention to what he no longer says as well.
I had Raoul Powell on for a chat a few weeks ago as well, and I'm sure you're familiar with his work. He's of the mind that actually the market has pretty much done the job for the Fed and raised rates sufficiently enough that we're seeing data come through, at least leading indicators. And he's saying that historically the ISM, where that's pointing, says the recession is all but assured if we're not in it right now, and coming quickly if it hasn't already arrived. So I wonder whether or not the Fed has any more credibility to stake on their words, given what we discussed earlier as well, and whether or not they're just keeping up appearances. Because let's remember also, as recently as, was it December, they were saying inflation, there's no sign of inflation. And then within 2 or 3 months, it's just gone through the roof and they've completely reversed course. They were late to inflation. Are they going to be late to the recession as well? And perhaps it's just a bit of play acting until the point where they have to say the data is in, the political risk is out, we have to act and reverse course. I guess there should be a question somewhere in there rather than my opinion. But I mean, I just wanted to put an opposing view and ask a comment on that, because do you see that happening? Do you see that the data is pointing to softening of the economy imminently? I mean, you tweeted earlier today about Goldman Sachs saying, was it slowly contracting or something like that, some misnomer that they used. So I just wonder whether or not the Fed is talking ahead of themselves, kind of like how they were missing the signs of inflation ahead, and they're missing the signs of recession as well.
Yeah, so let me just back up for a moment. At the beginning of January, I put out this article where it talked about the expectation in terms of 2022 being a big Fed gaming operation, in the sense that they had totally missed the boat in inflation, and they need to slow the economy down. And by the way, that's actually been working, right? And Raul's right. The market had been tightening for the Fed because we saw the 10-year going from 1.3% at the beginning of the year to 3.5%. That was a massive tightening process from a velocity perspective, without the Fed actually having had to go there, right? That was all the part of the jawbone effect. And it pressured asset prices, and then obviously we had the reversal in the yields. So that is correct, and that's what I said actually at the beginning of the year. Maybe what they want to do is let the air of asset prices enough to slow down the economy without producing a systemic event. And if you note that the first half correction, as deep as it was also extremely orderly. We didn't have any big blow-ups in the VIX. We didn't have any blow-ups, period. And there were, in a big bear market, you would expect some companies to blow up. We really didn't have any, so it was actually relatively calm. And you ended up with, while the S&P was making new lows, the VIX was making lower highs. Blame the option complex if you want, but it was not a fear correction, fear bear market in the traditional sense at all. So from that perspective, you can make the case, if this was the grand plan of the Fed, well done, because you did slow down the economy with blowing anything up. And then you have now this rally, and maybe things are coming back. The problem is inflation is not anywhere near 2%. I mean, look at rental prices and homes. Look at the still extremely strong labor market. Look at wage growth still being very high. And the worry has to be for the Fed that inflation is going to prove a lot stickier. Just because it's going to go from, let's say, 8-9% down to 5 or 6% doesn't mean you have victory on inflation. You're just stuck with higher prices that are still going up on an albeit slower rate. So you've really not won the battle in that sense. And I think the Fed is realizing that. I think they're very concerned about inflation being a lot stickier. So when everybody piled in because inflation was rolling over in July, that's a little premature, I think. I mean, that go back to the 70s, 80s examples. While it's true that you had a couple of examples, I think in 1982, inflation rolled over and that was the bottom in markets. But what everybody leaves out, conveniently to mention, is that the Fed had already been in an aggressive rate cutting cycle because we were in a recession at that time, right? They went from, 15% to 10% or something like that. I mean, in a matter of months. We're not in a rate cutting cycle. Cost of carry is still going up, right? So risk is the Fed's making another policy mistake. They were too slow on inflation. They ignored it. They let everything run wild. And now they get political pressure from people like Senator Warren in the United States saying they're worried about the Fed pushing us into a recession. Yeah, they have to. they won't say it, but they have to. Absolutely. So the other thing, just to finish up on that point, Powell made it very clear he doesn't want to become an Arthur Burns, which was to stop too soon, and then inflation's coming back, and that's what Kashkari said yesterday as well.
Okay, so on the issue of inflation, I mean, the structure of inputs into the inflation is different in Europe as it is in the United States. We've got some structural issues geopolitically playing into it here, and we're seeing gas prices going absolutely crazy. And I mean, you and I are both in the UK. Monthly gas prices on average are forecast to be between £500 and £700, which, for people listening abroad outside of London, a lot of people probably don't even pay £1,000 a month for rent in certain types of apartments and houses. That's a lot of money. How do you see that feeding into inflation? I mean, do you think that the Bank of England should even be considering that when it looks at inflation, or excluding that, having a look at discretionary spending and pressures on the consumer side only?
Yeah, this is a really not only ugly, but it's also a very difficult situation because as much as I may bang on the Fed, it's not their fault that Russia invaded Ukraine, right? I mean, there's some
And they can't
things,
do anything about that either. That's a
and they
very
cannot
different
do
thing. Yeah.
anything about that. We just had a global drought, basically, as you know, here in the UK. It's been just absolutely bone dry all year.
Hmm.
And I live here in the countryside. I know some farmers that live right next door, and they're all struggling. I mean, it's not a hypothetical issue. It's real. Yields, production, crop productions are down, and so forth. So that may just filter into food inflation as well. But yeah, the when I look at vertical charts that I see in Germany and so forth on electricity prices, that maybe that's kind of a bullish pivot in the sense charts like that are not sustainable. They're not economically sustainable at all, and the pain is absolutely real. And it is a concern. It is absolutely a concern here in the UK. They announced price increases of 80% for gas, electric, and a lot of households that are already struggling with inflation, they're going to be brutally hurt by that. In fact, you know, we're talking about societal stress. There's a movement here in the UK where people are calling on each other to refuse to pay their bills. Where's that going to go? They have to come up with a political solution. So, in a sense, you can argue maybe all these sanctions against Russia have been an own goal so far because they've not achieved what they were set out to do, which is to incentivize Russia to leave Ukraine. That's not happening, is it? So that's a really, really difficult situation. And if you look at this just from a sigma perspective, that's not recession, that's depression. If this does not revert here pretty soon, and they're talking of rolling power cuts here in the UK as well.
Yeah, this isn't hyperbolic speech at all by Sven. We're talking about, the leading, I guess, personal financial advisor in the UK is saying, I've got nothing else to tell people about how to save money. It's literally starve or freeze to death. A lot of people are going to have that choice in this upcoming winter of whether they eat or whether they heat. It's not hyperbolic at all to say that that is the choice a lot of people are going to face. Combine that with, almost 15, 20 years of wage stagnation. Certainly since I've been in this country, wages have pretty much been stagnant, even in London, except for the really high-end jobs. Wages have been very, very stagnant. I don't think in that 16 years that we've even seen a 40 or 50% increase in that time, while we've seen just household bills increase by 40 or 50% in the last 2 years. So you can
Yeah, and it's
see,
small businesses are totally affected by this as well.
yeah,
This,
yeah.
just a personal story. Just we had a barbecue over the weekend. We had a bunch of folks over, and the gentleman I know, he's in his late 70s. He's on a pension, and he was telling me, I mean, just saying this is not hypothetical. He's telling me straight out how he's now just limiting dishwasher and anything electric severely, to maybe once a week or something like that. He got a special little oven, a stove where he's cooking on separately. So this is real for people, and they're very much concerned. And unless they're sending out checks again, I don't know how people are going to cope with this. So which is kind of counterintuitive to the whole thing of tightening at the moment. So I think we're globally in a definitely very difficult situation. Doesn't mean we won't have rallies in markets and relief rallies, especially when things are overly extreme and you get some sort of hope that maybe things are improving on some of these factors. But in terms of just a historic debt and valuation construct, there remains a lot of room for coming volatilities, in my view.
Do you think that might mitigate the need for central banks in Europe, so the ECB and the Bank of England, to raise rates further? Because that's quite a steep hike in energy bills, and at least it would, I would imagine, dampen consumer demand a great deal. Do you think that would mitigate the need for further rate rises in the interim?
I cannot overstate how screwed the ECB is. I am. I just can't. I mean, remember they had their first rate hike in 11 years this summer, and they've mustered the courage to raise rates to zero from negative, while we have what today 8.8% CPI in Germany, 37.6% PPI in Germany. I mean, how is that a responsible policy? And they don't even want to, do QT. They may be willing to talk about it. I mean, there's been no tightening. That's what I'm saying. I mean, if you, any historic lens is out the window because we're not addressing these issues. And yes, you can argue this energy crisis is artificial from a geopolitical perspective, but if you look at the core mission of price stability, they've all failed absolutely miserable, and I think they are scary. They are scared. They should be scared of blowing something up that they then can't stop. But the problem is, what is your ability to stimulate the economy in any major fashion when you're still at zero rates? That's the vulnerability we have in the system. Back in 2000 or 2008, we were at what 5-6% effective Fed funds rate. So when they cut to zero, that had a major stimulative effect. Only at 2.3% in the U.S., with 0% in Europe. So maybe you have to look at this through the lens that in order for them to then, coming out of the next recession, having the ammunition to provide stimulus, they need to raise rates just for that reason, so they can actually cut them again. I mean, that's the box that they've put themselves into.
Yeah, and they've also got the added complexity of one monetary policy for diversity of fiscal positions as well, and I guess economic structures across the European Union too. Yeah, that's really tricky. It leaves me feeling quite depressed, actually, thinking more and more, because I think quite a lot of that is intractable. I mean, there's nothing that's going to suddenly bring upon an influx of gas into the market short of peace between, or some kind of resolution between Russia and Ukraine. I don't think that's on the cards. There was some talk that surely Europe and the United States would lean on both parties to, create a resolution, but that seems further away now than it's ever been. So I don't see a resolution there. Do you?
Well, I mean, this may not be reality based at all, but geopolitical, maybe the obvious solution is to say, okay, I'm just speculating here, of course, is to say for the Ukraine, okay, you give up part of that, or give up the Donbass region or whatever, give Putin, the face saving out this to be able to declare victory, and then have Russia pull out, and that would be just a massive relief, right? I mean, that then everything is over. I mean, if you get a whiff of that happening, and energy prices collapsing, and all these bottlenecks disappearing, that would be just a massive positive for the world at this point. It may be politically really tough to swallow for Ukraine, but I think that requires some really delicate, cohesive geopolitical policies for everybody. And yes, at this moment, I don't see it, unfortunately, because I think this is what is required to solve this before the winter hits, right? So in that sense, I presume Putin may be laughing because he knows he's really in a good negotiation position, because the pressure is not on them.
Yeah, I wouldn't say that he's in a strong position, but he's not without some strength either. That a lot of people assumed, particularly in Western governments, that they could simply impose sanctions without any consequences to their own people and nations as well. So that's a level of awakening that people hadn't counted on.
Well, in a rational sense, you would look at this and say, "Wow, the Russians are really hurting themselves. I mean, they're losing tens of thousands of people. and equipment, and you can argue politically this is actually an embarrassment. The great Russian army can't overtake Ukraine. What does that say about their ability to stand against NATO if that's the message they want to sell at home? But obviously they have control of their media, and there's no sign of protests because it's not allowed. So I can't speak to what the internal considerations are in Russia. Just from a world perspective, it obviously would make sense to get this solved. But typically wars don't last forever either. So I think we can only be hopeful that reason ultimately will prevail. But so far, no signs, unfortunately.
Do you think those conditions could bring about central banks not pivoting at all, given that it's a dampener on the economy? And so, yeah, look, I guess I want to move the conversation towards central bank policies and what could lead to a change in policy from, I guess people anticipate a pause before a pivot. What do you think could lead to that?
Well, a pause will come. I have no doubt about it, and a slowing will come as well. And that would be prudent. And again, we may have trained participants trained in the Fed pivot participants think that this is going to be bullish, and it certainly may lead to a relief rally, if you will, at the time when it comes. I think ultimately all of this will be driven by how fast the economy slows down into a recession. I think that's the key. If the economy stays stubbornly strong in the face of all this, then the Fed pivot is farther away. I think again, the only way to really solve this from a structural perspective, and this has nothing to do with Russia, Ukraine, and energy prices. It's just a reality of rental prices and wage growth and everything else. Inflation will end. There's no question about it. And we already see just dramatic rollovers in a lot of commodities, copper and lumber and so forth. So in this sense, these rate hikes have already done their job. But keep in mind, the Fed hasn't even really begun QT. That's supposed to start this week, right? They're going to $95 billion roll-off, and they're not going to be able to end that anytime soon because they've barely started. The balance sheet is only off 1.3% from the all-time high at this point. So from my perspective, the tightening, even if they pause, you still have a tightening effect from the balance sheet rollover. The Fed is not going to cut rates until the U.S. economy is solidly in a recession and you have an increase in unemployment. That's when they're going to cut rates.
I heard the Fed's comments on employment still remaining relatively strong, but I suspect that sort of that underestimates the level of hurt that people are going through, even though they may appear statistically to be gainfully employed, because of what we're seeing with rising consumer prices and the like. Are there any metrics you think that would counteract what the Fed is looking at, other than, consumer confidence to me it seems like a fairly fickle and superficial measure. Is there anything else that we can look to that might show people they're hurting right now? They might be employed. They might not all be unemployed, but they're still hurting despite having an income.
You can see it clearly in the personal savings rate and credit card balances. We've just seen a massive increase in credit card balances, in a rising rate environment. That's and if you combine that with the actual results in retail sales, it just basically tells you people are making ends meet by going into debt. We just had 18 months of negative wage growth in real terms. That's not sustainable. That's why the Fed has to get inflation down. They know that too, right? So I think to the extent that people still had savings from the COVID times, those are running out rapidly and depleting rapidly. And of course, as I said, you just had an increase in consumer confidence. Why? Maybe because gas prices come down, but the gas price is not the only aspect of inflation, right? So, no, this is going to keep going. I think we all need to be clear on this. And the lag effects will be with us very much into next year. And even in the futures market, it's now eased off a little bit in terms of when they expect Fed rate cuts, maybe later into 2023. Again, it depends on how quickly the economy goes into recession.
Okay, this is going to be an unfair question, but let me put you under the spotlight as we close this hour off. So how do you see it for timelines? Fed, pause, pivot, when is it going to happen? And what do you think the response will be time-wise for Bitcoin as well?
Well, see, this is a completely unfair question, but I'm not going to cry about it. No, I think, look, part of it is also how people react vis-a-vis their expectations. I'll just throw a couple of thoughts out on there. One is, and I'm very mindful of the political background as well, because we do have midterms coming up. And midterms are in early November. It may well be that the Fed opts for a rate hike in September and then pauses because of the political window. I think a rate hike will definitely bring screeching from politicians about the risk of recession. And the Fed has in the past been evidently, while they claim independence, they are certainly aware of political considerations as well. But they have stated, like Bullard and these guys, they want to be at 3.5% and 3.8% by the end of the year. Well, that tells me, a pause may not be feasible this year if that's where they want to go. The second aspect is seasonality, which is of interest. Midterm, each year the S&P has a certain seasonality associated with it. They're all somewhat similar, but they have some different tacks to it. And for some reason, the midterm seasonality chart is interesting because while obviously this first half of the year was extremely down, directionally in terms of month-to-month directional flows, it's actually kind of been tracking fairly closely. It says down in the early part of the year, then a midsummer rally into mid-August, which we just had, and then another rollover that may or may not produce new lows into September, early October. And then that seasonality chart calls for a big rally into year end. As we know, markets sometimes do the unexpected, and sometimes they do things that may not be fundamentally justified. But the reality is, I think a lot of people are looking at this as well and are calling for a year-end rally to some degree or another. So if you get the Fed to pause, for example, right around that time, that may be enough to produce relief into year-end. To me, that doesn't mean anything about what happens in 2023. I think just from a trading perspective, and that's obviously where I come from, I want to stay open-minded in terms of, I understand, I see all the issues on the macro basis, but as dire as things were in mid-June, from a technical perspective, when we see the bullish setup, we're not afraid to take that either. But we'll have to see how this now evolves here into September. I think one of the key aspects, of course, is what our next inflation report is going to say, and we're going to see continued rollover in CPI and PPI, PC, and so forth. That then maybe gives the Fed the ammunition to say, okay, we're going to pause now. We're going to assess how things evolve. But keep in mind, and this is why I'm pointing to 2023, even if they pause or slow, it still means we're still seeing the lag effect of all this rolling into the economy. Especially, they're not going to pause QT. They're just getting really started here in September and October. And none of us have ever seen a Fed tightening as aggressive as this. This is new, right? So that's going to be the undiscovered country here.
Interesting. Sven, where can people find you on Twitter and online?
Well, on Twitter, it's NorthmanTrader. Hopefully, I'm the only type of account there. As I've seen, you have all your fake accounts.
Yeah, tell me about it. I've got a Twitter shadow ban at the moment, so you literally cannot find me if you're not following me already.
Oh dear.
Yeah.
I got banned by Twitter, or suspended by Twitter a few months ago. I had to nuke all my tweets because of some copyright issue.
So how did you resolve it?
I nuked my tweets. I mean,
Oh,
because they said, if it happens again, we may suspend you permanently. And I had 30,000 tweets out there, and I don't know what could be copyrighted or subject to copyright claim or not. So I just made the easy decision. I just nuked all the tweets.
oh, I can't do that, though. It's supposed to be the Bitcoin archive. I can't. They haven't told me what I've done. They haven't told me what I've done. All they've done is basically muted my replies. You can't find me, so I don't come up in search suggestions. Like you used to be able to type in Bitcoin, and I'd be like the top 3 or 4. Now, even if you type in Bitcoin archive, it doesn't even come up in the search, and you can't see any of my tweets in searches as well. So, it's really pissed me off.
What we can see, though, is all the spam bots replying to all of us, right?
Yeah, exactly. And
they
dozens.
seem to have some problem. Oh, yeah,
sorry.
Thousands. Anyway, so it's at NorthmanTrader, and then NorthmanTrader.com is the website. I also have a podcast out that's for free. It's called the Northcast. That's pinned to my Twitter handle as well, and I try to explain charts and what I see from a technical and macro perspective as well.
Sven, thank you very much. It's been a pleasure. And when I build the studio, I'd love to have you in person as well.
Where are you based in the UK?
I'm in London, yeah.
London, okay. I'm not too far from here. So, yeah, let me know. Thanks very much for having me.
Thanks, guys. I appreciate you all tuning in. Until next time, bye.